I'm going to be teaching you guys about trading on the right side of the V. This is one thing that really helped me, and I've noticed it is a major change that any of my students make. This is one of those changes that helps to lead to a transformation in your trading that then takes your trading to the level of profitability. Small changes that add up into a transformation that takes your trading to profitability. This is definitely one of those key changes that needs to be made in your trading. The left side, you're thinking you'll get a better entry price. You're getting in the market earlier. You get those really good entries that limits your risk. You think it's limiting your risk. You think it's getting you in at the best possible time. But in reality, it's doing almost the exact opposite. I have an example here. You had a fair value gap here, correct? You would put your limit order inside of it somewhere, maybe put your stop up here. But what if you were to wait? What if you were to wait to see reaction? What if you're patient? Now you see a bearish reaction. It ended up going up a little bit further there. Now you go ahead and enter. And that's exactly about where you would put your limit order there, right? And now I have a defined risk. My risk is going to be at 55. You would have had to put your stop here at 58. So less risk, higher win rate, and same or if not better entry taking trades on the right side of the risk or the right side of the V. You don't want to be selling on that side of the curve, but you do want to be selling on the right side of the curve. You can think of it same thing as the buy side of the curve, sell side of the curve. Chances increase greatly. You have a couple fair value gaps here. There's some of this area left open here. I'm going to put my limit order here. I'll put it right in the middle of this fair value gap here. You'd be trading on the left side of the curve. Boom. What good does that do you? And not much. Stop out. I understand why you might be worried about missing out on trades. If I was trading fair value gap still, let's say I was like, okay, I want to trade this fair value gap. I would drop down and I'd be like, okay. And then I'd wait for the V to form. Here's your left side. Boom. There. I would wait to see that the fair value gap is being respected at the closes of the candle. I have a defined risk. I'm not guessing, right? This is the exact same thing I showed in the beginning of the video. Exact. Point of interest here. Limit order here. Market order on the right side of the V here. Same entry price, much lower risk because you don't know where it's going to reverse at. You probably would honestly got stopped out on this one too. If you set your stop here where you would have put your stop below this low, and then that's a lot of risk. That's 10 points. How much am I risking? I'm risking 8 points. That's a lot less risk. It's not a whole bunch, but 2 points adds up over a set of trades and a much higher win rate. Let's look at some reasons why I used to trade on the left side of the V and why some people do. They just probably just don't know what I'm talking about here is probably why, or else they would trade on the right side of the V. So the first one is the spread. That's the first reason that would cause somebody to choose to trade on the left side of the V. If you're trading forex, I would just get out of that. You guys are getting screwed pretty hard. You guys' spread is quite wide. The spread, by that, the price between the buyer that's willing to buy and the seller that's willing to sell at a price. The spread in forex can be quite wide, maybe depending on your position size, $5 to $10. But how much extra risk are you going to put on to try to avoid the spread? In this case, it was extra 2 points. So that would be with one contract, that would be $40. You're trying to save yourself $5 to $10 for an extra $40 of risk. That's not very good math, is it? You're going to have a low win rate trading on the left side of the V. It's just how it works. Because your educated guess is less educated. They're afraid if they don't put their limit order in here, that when price comes through, it's going to immediately bounce and go without them, which I understand that fear. I guess it's impatience and it's fear-based. FOMO is causing this. But you have to realize that the market is unlimited. It's got unlimited opportunities. There's no reason to think that the market goes without you. If it does, it's okay. There'll be another one. And then greed. it goes into FOMO too. It's all tied in fear of missing it, fear of not getting in, fear, and then greed. I want to get it the best possible entry so I can get the most possible profit out of the trade. That's not a good way to trade. Really consider trading on the right side of the V, guys, or the right side of the A. Really no benefit to you on the left. There really isn't. I can't think of one benefit, honestly. I really can't. If you guys know of a benefit that I'm missing, please comment in the comments below. Thank you for watching.